Hi, my name is Amanda from Macquarie Warrens, Malaysia, and today we have Daryl Guppy, renowned financial columnist, author, and inventor of the Guppy Multiple Moving Average with us. So grab a cup of coffee and listen in to our chat on the US market. Hi, Daryl. Thanks for joining us today. Given the current challenging macroeconomic backdrop, how could investors navigate these challenges in the second quarter of 2023? Where do you see the US indices trading to on the back of this?
Hello, and welcome to this second quarter market outlook. Apart from the continued rise in interest rates, there are two important factors that we need to consider. And the first is that four-letter word. We cannot understand US market activity unless we consider debt. US debt is equal to the combined debt of China, Japan, Germany, and England. And that suggests that we are likely to see a continued rise in interest rates, at least for the next quarter. Free money is becoming less free, more costly, and that has an inevitable impact on the viability of companies. And the first way that impact is felt is in the banking sector. So here's the key question. Is the current situation a result of policy or of product? The 2008 global financial crisis was a result of product. Banks were over-leveraged to CDOs, collateralized debt obligations. Once the instrument collapsed, then the banking sector collapsed, taking first the economy and then the world economy with it. In the current situation, what we have is a policy environment, partly driven by the fact that bank asset reserves under President Trump were reduced from 10% to 0%. Combine that with a good old-fashioned run on a bank and you get a liquidity crisis that can only be solved by policy direction. The Fed has indicated that they are going to continue with the existing policy direction. That's essentially what the most recent interest rates rise by 25 basis points tells us. There is no change in policy. With that in mind, with that macroeconomic situation in the background, we can make a more informed analysis of the charts of the Dow, the S&P, and the Nasdaq. And what's particular importance is to identify whether there is any divergence taking place in those market behaviors. We start with the Dow. We use a weekly chart because a weekly chart is most appropriate for identifying longer-term quarterly market outlooks. There are a couple of important features. The first is the head and shoulder pattern, shown here as A, B, and C. These are generally fairly reliable reversal patterns. And in using the pattern, we measure the depth of the pattern and project it down to set a potential target for where the market is likely to pause. We found that the Dow achieved this target, and that target identified with previous support and resistance levels. The market has since been defined, the recovery, by this downtrend line. The breakout that took place above the downtrend line created an equilateral triangle pattern. This is a pattern of indecision. That means that there is about a 50% chance that it could break on the upside and about a 50% chance it could break on the downside. It's broken on the downside. Where are we likely to see market pauses? What we know is that this downtrend line is most likely to act now as a support level. And that's an interesting chart pattern. Think of it like a playground slide. The market is likely to hit that trend line and then continue to move down that trend line using it as a support feature until it reaches a long-term historical support feature. And here is the long-term historical support feature. So what we're looking for in the next quarter, potentially, is a continuation of bearish pressure until support is successfully tested and that then followed by a rebound. So in the short term, we're bearish. We're waiting for confirmation that support can hold at previous levels. If it does, then we're prepared to go long on the Dow.
Thank you for the insights, Daryl. Just jumping in here to quickly show investors how they can use warrants to trade any potential short-term weakness in the Dow. Now, there are two kinds of warrants in the market, a call warrant and a put warrant. A call warrant tracks the move in the underlying that it follows and is used by investors who see the underlying moving higher in the short term. A put warrant, on the other hand, moves in the opposite direction to the underlying and is therefore for someone who is bearish on the underlying and thinks it will fall in the short term. Those keen to gain leveraged exposure to the Dow Jones may consider the current focus call warrant DJIA C6 and put warrant DJIA H5. These warrants have an effective gearing level of approximately 9 times, meaning the warrant price tends to move by approximately 9% for every 1% change in the Dow, allowing investors to gain leverage exposure to the Dow with a smaller capital outlay. And with that, I would just like to ask Daryl, what is the difference between the Dow Jones and SP 500? Will the S&P 500 replicate the move seen in the Dow?
Although we use the Dow for everyday headline media events, in reality, it's just a handful of stocks. It doesn't adequately represent the entire market. The S&P 500 is a better index for understanding what is happening within that market behaviour. So the key point is, does the S&P replicate what we see on the Dow? We don't see the same equilateral triangle pattern that we saw on the Dow. There's been no strong breakout from this downtrend line on the S&P. But the S&P, like the Dow, is using this downtrend line as a new support feature, and it takes it inevitably, if you continue down with the downtrend line, to intersect the longer term horizontal support and resistance level. Again, on the S&P, we saw a head and shoulder pattern. When that is measured, that measurement gives this downside level here. So we're looking for a continuation of the move on the downside and a retest of support. The conclusions that we reached on the Dow also apply to the S&P.
Thanks, Daryl, for sharing on the S&P 500. If you were of the view that the S&P 500 was on a short-term downward trend, you could once again consider using a put warrant to hedge the downside. Those keen to gain leveraged exposure to the S&P 500 may consider the SP 500 C20 and SP 500 H23, which currently have the best liquidity, meaning they have high volumes placed on the bid and offer prices and are on tight spreads. You can use the Live Matrix tool to see where the warrant prices will be based on the underlying level and can quickly check whether a warrant is on tight spreads. Finally, we do have warrants over another US index, the Nasdaq 100. The Nasdaq 100 has moved quite differently from the Dow and S&P so far, rising 16.7% year to date as of 24th of March. Consequently, we have seen the Nasdaq trending call warrant rise during this period. Daryl, how do you see this current divergence between the Nasdaq 100 and the other two US indices playing out in the near term?
So does the Nasdaq reflect what's happening in the S&P? Can we use the same strategic approaches going forward in the next quarter? Broadly speaking, they're similar charts. Again, we have the head and shoulder pattern. We have the calculation that sets at a minor historical support resistance level. This is very confused on this side, but it established itself as a fairly strong support level. But the Nasdaq is more advanced than the pattern development on the S&P or the Dow. That is, we've tested the support, had a rally, tested support, had a rally, tested support, broken above that downtrend line, haven't established the same pattern that we saw on the Dow, but the action on the Nasdaq is closer to the historical support level and the intersection of the downtrend line. That means that investors and traders can use the behavior of the Nasdaq as a leading indicator and guide as to how the price activity or the index activity may develop on the Nasdaq, on the S&P and the Dow. So what we're looking for, we're looking for a retreat, a general bearish environment, and a test of these two support features, the downtrend line and the horizontal historical support level. A rebound from the Nasdaq suggests that we will see a bullish rebound in both the Dow and the S&P. The Guppy multiple moving average applied to the Nasdaq shows us that there is weakening downtrend pressure. The long-term group of moving averages is beginning to compress slightly. So let's summarize. We're expecting a continuation of bearish pressure in the early part of the next quarter, but then followed by a rebound rally. The leading index is the behavior on the Nasdaq. It's not a big lead, but it's enough to give us a clue as to how the Dow and the S&P are likely to develop. So how do we trade? How do we position ourselves in this environment? As always, it's your choice. We need to filter our individual selections against the strategic background. We can work in conjunction with the index, or we can fade the index. Working with the index means that if we believe it's bearish, we continue to trade on the short side. If we want to fade the index, we look as the index moves towards its support and resistance levels, and then we take the opposite position. In other words, we go long in anticipation of support being effective in the indexes. But it's your choice as to how you approach these markets.
Indeed, it's your choice, and warrants are here to offer you the opportunity to participate in the market moves with either or both choices. Whether bullish or bearish, investors may gain leveraged exposure to the Dow Jones, Nasdaq 100, or S&P 500 via call and put warrants. Finally, do subscribe to our newsletter and follow us on our Facebook and Telegram channels to not miss out on our next video. You can find the links in this video's description. Thank you for watching today.